Manishi Raychaudhuri joins us. Let's understand from him that what he makes of the global construct and why the India outperformance is real. Manishi, good morning. Thank you for joining us. Manishi, there is a bit of a global scare in the world, but that is not having an impact on Indian markets per se. FIs are selling, but DIs are buying. So do you think we are in for more of the same for next couple of quarters now, next couple of months?
Well, it's been a story of India for quite some time now. Think of the period October 2022 to somewhere around, I think October 21 to June 22, rather. There was almost, I think, about anywhere between 23 to $27 billion of FII selling during that period. What did the market do? Hardly anything. It was, I think, down about 5% or so. If you go back about 5 to 10 years, that quantum of selling would have made a serious dent in the market. But this newfound enthusiasm on the part of the domestic investors, and this has been going on for the last 3 to 5 years, actually places India in some kind of a unique sweet spot among the emerging markets. There's almost no other emerging market where the domestic interest and domestic action in the equity markets has increased to this extent. And consequently, no other market where the domestic influence is more than neutralizing the fluctuations in FII interest. So I think, yes, I mean, going forward over the next quarter or so, we're going to face uncertainty about the monetary policy trajectory of the global central banks. And naturally, equity markets worldwide, and possibly more so in emerging markets, we would continue to see volatility. India would continue to remain relatively insulated. And one strong reason behind that is going to be this, the domestic investor enthusiasm that we're seeing right now.
Manishi, so curious to understand, considering India continues to be the preferred destination, where is it that you've added positions or, executed fresh buys in your recommendations?
In our Asian model portfolio, we have been overweight on India for about 3 months now. We were, kind of neutralish in the first half of this year, but in late June, we turned overweight. And the big weight in the India silo are financials, number one. That's predominantly private banks. The second important silo are the consumer universe, a bit nuanced here. So we have significant weight in autos, consumer discretionaries. And we have recently added some bit in consumer staples. The relatively the low end as far as the valuations are concerned. We are a bit cautious about valuations in the consumer staples segment. And apart from that, we have significant weight in TMT, tech, media, and telecom, both IT services and telecommunications. And when we talk about telecommunications, we are referring both to pure plays and conglomerates. So, if one compares to the benchmark weight, our overweight stance on India is possibly the most pronounced. We do have overweights on Hong Kong, China, and Korea also, but they're relatively lower in comparison to the benchmark weights of those markets.
India remains one of the top weights, and financials, of course, is driving that confidence. But Manishi, what's the sector which is a very clear underweight right now, one that you should completely stay away from?
We are not too positive on metals, mining, materials. As long as China, economic growth in China continues to disappoint, and the real commodity demand boosting sectors like property continue to face turmoil over there, I think it would be prudent for investors to stay away from the commodities, particularly materials and mining. We are also, I mean, even though I talked about, adding consumer staples in a small way, for much of the very well penetrated large frontline consumer staples companies in India, we are a bit cautious about their growth trajectory going forward. also the kind of valuations that they are trading at. So those are the two sectors that readily come to mind, when we talk about staying cautious about certain segments in India.
Then if the recent material prices have gone higher, if US economy is coming back, I mean, nobody's working with the assumption that US demand could surprise us. Do you think the China concerns will be diluted?
As far as metals and mining are concerned, vast majority of consumption, close to 50 to 60% of most of these are consumed in China. So the only exception I can think of is energy, oil and gas, where the Western Hemisphere still remains in the driver's seat as far as proportion of consumption is concerned. But apart from that, when one talks about industrial metals, etc., I think China still remains in the driver's seat as far as demand goes. The only, tiny little exceptions that one can think of are the metals which go into the EV supply chain, the electric vehicle supply chain, because EV demand, after suffering for a few quarters, has again revived in China. So, those are some bits and pieces of minor exceptions that I would point out. But for much of the frontline industrial metals, I would possibly still stay away.
Just to know what you're making of the big move that one is seeing, across categories and especially defense-related themes. Pure play defense manufacturers, shipbuilding, even railway stocks. The infra theme has really come to the fore, and it's these newer sectors which are finding value amongst investors.
In fact, that's a very interesting point to make. And my apologies, I did not mention one of the core sectors that we are focused on in India. In fact, industrials is a sector that we added sometime in June to our Indian silo of the portfolio, and for exactly the reason that you pointed out. The government expenses on infrastructure, that has been going up steadily. If one looks at the proportion of government capex as a proportion of total government expenditure for the past 3 to 4 years, it has really skyrocketed. It used to be about 15 to 17%. It's gone up to 25% in the latest budget. Much of this is coming in railways, in shipping, in port and other inland transportation. So intra-city mass rapid transit. So these are the sectors, and of course defense. One can't forget that. So these are the sub-segments within government capex that we're positive on, and we think that it would also have a rub-off effect on private sector capex. One can't forget the China plus one story here as well. We're seeing the initial nascent signs of that. So all in all, we do remain focused. We do remain positive on the capex story in India, and our inclusion of industrials is a reflection of that constructive attitude.
Industrials positivism is something which is quite visible, but Manishi, is this view valid for even the power stocks?
You see, in power stocks, we think one has to be a bit nuanced, because the focus of India, much like most of the emerging markets and the developed markets, is possibly going towards green transition. So that is where much of the incremental expenditure, much of the incremental policy initiatives would possibly be focused in. So we don't have any specific inclusion or specific stock that we have, but much of the frontline industrial companies are also engaged in that area. And it's a space that we would definitely be watching carefully.
Such a pleasure having you on the show today. Thank you so much for taking the time out.
Thank you. Thank you very much.